Can we use the past to predict the future? This is our recession forecast. We receive a tremendous amount of great comments and questions, and this is one of them in regard to the stock market, the valuations that can't go any higher. But let's get right to the point. When the stock market will. At the end of the day, macroeconomics, it's fun to talk about this kind of stuff, the reports and the trends and the data. But at the end of the day, we all want to know the same thing. What's the stock market going to do? When will the housing market crash? When will this recession that we've all heard about, when will that begin? When will be a good time to buy a house? Well, there's two elements to finding the trade. There's fundamental analysis. That's a study of macroeconomic trends, the reports that we go through every week. Then there's a technical analysis, the study of the charts, the market's actual price action. Now, I don't think it's wise to use one or the other, but rather a blend of both. The fundamental analysis tells us the story of the economy, which direction we're going. The technical analysis tells us exactly what's going on within the charts, the buying and selling pressure. What we're going to try to do is first take a look at fundamental analysis, then technical analysis, and show you the similarities to the last Great Recession, so we can try to find a little bit of a timing tool in this. First, manufacturing orders, and there are no specific economic numbers that will tell us where the recession will begin because every economy is different. So we're going to take a very broad-based look at the economy. Here's manufacturing orders. Now, on the left-hand side, that's present date. The last year-over-year result was 1.3%. Well, we want to ask ourselves on the right-hand side, going back to the 2008 crisis, when did we see 1.3% manufacturing orders on a year-over-year basis? That happened to coincide with roughly August or September of 2008. And we can see at that period of time, the manufacturing orders were ratcheting up to around 8%, 6% on a year-over-year basis in June and July of '08, and then precipitously fell right before going to negative territory. Now, does this mean that the next print on our current basis will be negative? Not at all. But we're just trying to gauge, as far as the manufacturing orders in particular, where are we? Where is manufacturing compared to where it was around 2008? At that point, this level puts us around September of '08. We can consider CPI, Consumer Price Index. We just had a great number, 3.3%. Consumer prices are declining. Now, we want to see consumer prices decline. We want to see inflation go down. But recessions are also categorized by a very steep drop in inflation. So we want to see inflation go down, but for the right reasons. When was the last time we saw inflation dip back down to the 3.3% level? Well, in October of '08, we had the 3.7% level. Now, that was followed with a 1% inflation, then flat, then negative territory. So it's important not only the number itself, but the velocity of change. We want to see inflation come down, but I think it would be more of a healthy market for inflation to come down slowly, 3.5, 3.4, 3.3, like we see now, as opposed to an '08, 5%, 3%, 0. We can consider industrial production. The latest result, that was actually not so good. That was negative 0.4%. On the right-hand side, where does that put us? Around April of 2008, we had a reading of 0.8%. That was following the prior number that was barely in positive territory, 0.5%. And you'll notice, by the way, there's a trend, a similarity between these different numbers. The current indications put us right around mid-2008, more or less. Now, again, the 2008 recession was very much characterized by the housing market and the failure in the banking sector. This recession, if it arrives, will be characterized differently, just as a 2001 dot-com bubble was different as well. So we look at the different numbers to try to get the most educated, broad view of the economy. We can consider non-farm payrolls. The latest result was quite good, 272,000 jobs, following the last month's 165,000. Well, we can see in March of '07, we had 226. Notice it's pretty interesting. In February of '07, it was a very bad number, 81,000 jobs. Then it was followed by a really good number, 226. Well, in April of this year, it was 165, a very bad number, followed by 272, a very good number. So we'll see the non-farm payrolls fluctuate, but you'll notice a pattern in '06, '07. We had a bad number, but the next month it quickly recovered. In February of '07, it was 81. March, 226. That's good. April, 60. Not good. May, 151. Better. And then the market turned sour. Well, last month was 165. This month is 272. Next month is crucial. We don't want to see a very bad number. We want to see this continue to hold at in the twos, I would say at least. We could also consider retail sales. The latest result was 2.7%. Not such a great figure. That was following last month's number, 3.5%. 3.5 is better. Well, where does that put us? Around August of '07. That was around 2.7%. But we also had prints in December of '07 around 2.9%. And even 2.2% in June of '08. So retail sales doesn't look that bad. It's probably one of the better barometers that we're watching, especially compared to the manufacturing data. But certainly the latest result is not that bad, but that January print of negative 0.3%, that's pretty troubling. So as far as the macroeconomic picture is concerned, I would say we're neutral to somewhat on a weak stance. It's not awful. We're not in negative territory, but we are hovering not that far away either. Now, the other side of the coin, technical analysis. From the fundamental point of view, we see the economy is not strong. It's not awful, but it's not strong. In terms of technical analysis, as stocks forecast future corporate earnings, bonds, specifically US Treasuries, forecast future economic conditions. What's the bond market telling us? Well, in gray, we see the S&P 500. This is present day. In blue, the one-year U.S. Treasury yield. In red, the 10-year U.S. Treasury yield. Where are we now? The 10-year, the red line, is trending lower. It's moving away from the 1-year. Now, it's important to recognize why these two bonds move. The 1-year, the short-term bond, that moves in anticipation of future interest rate decisions. The 1-year bond, the short-term maturities are very sensitive to the expectation the Fed may raise or cut rates. We're going to see in just a moment exactly how that works, by the way, in previous charts. The 10-year moves more in anticipation of long-term future economic prospects. What's the economy look like 3, 5, 10 years from now? That's trending lower. Well, consider the spread between the two, the spread between the 1-year and the 10-year. And by the way, we have still very much an inverted bond market. An inverted bond market occurs when the short-term maturity pays a higher yield than the long-term. The blue line is above the red line. We've had this condition since June of 22. It's the longest inverted bond market we can remember in recent history, really. And at the moment, the 110 spread is at a negative 80 basis points. That's a pretty significant amount, and it's actually widening. It's important to note that. We're going to show you what that means for the stock market in just a second. Notice the pattern over here. More or less, the 1-year Treasury in blue, it's fluctuating, but it's moving sideways. It's not going up or down. It's weak lately, but it's sideways. The red line, the 10-year, that's trending lower. And for some reason or another, the stock market seems to like this. In red, S&P 500, challenging new highs almost on a daily basis. In the bottom, the 10-year, the 10-1 spread, that's in white. Now again, the white line reflects the difference between the 10-year Treasury and the 1-year Treasury at a current negative 80 basis points. 80 basis points is 0.8 of 1 percentage point. So the 10-year bond is almost 1 percentage point below the 1-year. And as that moves lower, the stock market likes that. Why is that? Well, there's a common belief that the stock market is going up because it's anticipating that the Federal Reserve will raise rates in the future. To cut rates in the future. And the stocks like the idea of lower interest rates in the future. But the stock market's not panicking. The stock market's not panicking because a 1-year bond is not going down. We'll show you when the stock market panics as the 1-year bond goes down. But at the moment, we can see very much an inverted relationship, so to speak, an inverted correlation. When the spread contracts, the stock market doesn't like that. When the spread expands, the stock market does. The spread is expanding right now. The spread, meaning the white line, is going down. The 10 is drifting lower, further away from the 1 year as the stock market goes up. Now, in 2008, the inverted bond market comes to an end as the recession begins. After all, technical analysis, we're looking for the trigger. We're looking for the signal. When do we buy? When do we sell? In gray, S&P 500. And this is, by the way, 2007 through 9. This is the chart. 1-year bonds in blue, 10-year bond in red. Now, notice in particular, the inverted bond market, when the 1 year in blue was above the red line, the 10-year, it crossed back below the 1 year, the 10-year, I should say. As that occurred, the stock market said, okay, now we don't like this anymore. The 1 year started to travel lower at a very fast clip, as so did the stock market. The stock market actually, if you look at the data, it actually followed the 1 year lower. Now, notice the 10-year, it was trending lower, but more or less sideways. But the 1 year was really the catalyst. The blue line was really accelerating to the downside, and that was a trigger in the stock market sell-off. The Fed, by the way, and this is important to note, we're all trying to guess when the Fed's going to cut rates. I don't think we should necessarily want that to happen so quickly. The Fed did not start cutting rates in '08 until the recession began. And that's the forward-looking thinking right now, is that if the Fed cuts rates, it means we're in trouble. Here's Fed funds in gray, in yellow, S&P 500. Again, this is 2007 through 9. And notice, as the Federal Reserve started to cut rates, this coincided with the S&P 500 selling off. You see, there's a very interesting dynamic. We're all trying to guess when the Federal Reserve is going to cut rates. Right now, September, it looks like there's a greater than 50% chance that may occur, although we've been pushing that level back, for the better part of the year. For us to come down to the Fed target around 2%, that's a very tall order. We don't know if that's going to happen. But if the stock market starts to crumble, if we start to see single digit and double digit non-farm payroll numbers, if we start to see manufacturing really fall apart, then the Federal Reserve is going to say, listen, we can't wait for lower inflation. We have to start cutting rates in response to the crisis. Well, this is what happened in '08. The crisis began. The crisis was the reason why the Federal Reserve cut rates. It wasn't because we hit that inflation level. It's because the Federal Reserve needed to help the economy. Well, notice again, this is 2007 through 9 in gray, Fed funds, in blue, the 1-year Treasury, in red, the 10-year Treasury, and notice in particular, the 1-year Treasury bond led the Federal Reserve, or I shouldn't say led, it coincided with interest rates going down. The 1-year Treasury bond, the short-term maturities are very sensitive to the expectation that the Federal Reserve is going to raise rates or lower rates. So when the 1 year starts going down, that's the signal the Federal Reserve is going to start cutting rates. Where are we now? Well, we're going to show you in actually just a second. Here in gray, S&P 500. Again, in blue, 1 year, and red, 10-year. Now, the S&P 500 in particular, notice this is the dynamic in 2008. The stock market followed the 1-year Treasury lower. In blue, again, is the 1-year Treasury. That went down, but if you look at the data on a more micro level, you'll see the 1 year made the move first. The stock market followed. Why did the 1 year go down? Because it was anticipating the Federal Reserve is going to cut rates. Why was the Federal Reserve cutting rates? Because they saw the economy really start to get in trouble. So it's a case of, which came first, the chicken or the egg. At the end of the day, everything kind of happens together. The 1-year Treasury goes down following the expectation the Fed's going to cut rates. The Fed's going to cut rates because they see the economy's in trouble. The stock market sees the Fed's going to cut rates, but the stock market is also anticipating lower corporate earnings. So everything, again, kind of happens together. Where are we now? What's the 1 year look like, for example? Are we in trouble yet? In gray, S&P 500, in blue, that's the 1 year, and red, 10 year. Well, at the moment, the 1 year, and this is good news, is trending sideways. That tells us at the Federal Reserve so far, they're not ready to cut rates. We know that because the 1 year is telling us it's not going down. The red line, the 10-year treasury, is going down, and that's why that spread is increasing, 80 basis points on the negative side. The red line is telling us that future economic prospects do not look so good, and that long term we probably see lower interest rates, and the stock market, some sectors of the stock market seem to like this. But the omen is, if we start to see the 1 year, that blue line, start to trend lower, then we know maybe the dynamic has changed. Maybe we know we're closer to a Fed cut. So the question, so what's now our trade? What do we do now with all this information? We're not yet in trouble, but what do we do? Well, the famous stock market speculator, probably one of the most famous of all time, Jesse Livermore, he was noted in saying, money is made in sitting, not trading. So the best thing to do if the trade is not there is to wait for the optimal conditions. Now, it doesn't mean that we can't get involved in a trade now, but as far as timing the recession, this is at least what the bond market is telling us and the macroeconomic numbers are telling us. We're not there yet. We're not in recessionary levels yet. It's not going to happen also in one day either. That doesn't mean that we should become complacent either. We really want to continue to monitor the economic numbers very carefully because the nuance is important. Our goal, we aim to look beyond the surface of the numbers to understand the complete picture. And this is a perfect example. We spoke about this the past couple of days. The CPI report, the Consumer Price Index, it was lower, month over month, flat. We celebrated. Almost the entire economy celebrated. Inflation is coming down. But we took a deeper dive into the CPI data, and we saw the majority of the weakness within this data was actually centered around a decline in energy prices. We saw crude oil come down about $10, $15 over the past couple months as well. And that's mostly attributed to a massive amount of selling of our gasoline reserves and our oil reserves. So maybe inflation isn't coming down as much as the headline has told us. And by the way, if you're interested in the details of this report, I think that you'll find what we discovered to be quite interesting. And what we're going to do is continue to monitor all of these economic reports, very carefully and try to give you the complete picture as far as where the economy stands right now and what we can expect in the near-term future.